One. And welcome everybody to another episode of Smart Money Circle. I'm your host, Adam Sarhan. With me today is a very special guest, Scott St. Clair, manager of the Premium Product Group at Investors Business Daily. Scott, welcome to the show.
Thank you, Adam. It's nice to be here.
Thank you. So I always like to ask, can you tell us a little about your background and how you got to be where you are today?
So as we discussed earlier, I can get a bit long-winded. So I guess it depends on how much time you have, because I've been in the game for a while, but I'll try to make it brief and engaging for your client, for your listeners. I wanted to go to law school. I got out of, undergrad and applied to, I don't know, 8 or 10 different law schools and didn't get in anywhere. So I said, well, I better get a job. And one of my teachers in my investment class, he was a stockbroker, and he seemed to, really talk, really enjoyed his experience as a stockbroker. So I thought, oh, well, maybe I'll try that. I had no idea what a stockbroker really was, Adam. And this is 1994, 95-ish.
Mm-hmm.
So I applied and got a job, and it was a grind. It was really, it was up at 4 a.m., out the door at 5 p.m. Saturdays, smiling and dialing. It's very much like the movie Boiler Room.
Right.
If you've ever seen that movie.
Yep.
Very similar. I lived that for 4 months. We didn't sell fake companies. The companies we were trying to sell to clients were real, but it was that type of atmosphere. And it just wasn't for me. It was really, I just knew right away I was in way too deep. So one of my friends could tell I was going to quit. Yeah. And he said, I have a friend that's a stockbroker that's looking to train somebody, and he had been talking to me and talking about charts and William O'Neill's philosophy, Investors Business Daily's philosophy. And it really kind of resonated with me. It made more sense. At the place I was at, the joke was the best time to buy a stock was when the market was open. So there was no process, right? You just called the guy. If he was willing to buy, you bought it, right? Yeah. Regardless of price or what the market was doing. So I went to work for him, and this was a much better experience, and gradually, started to, have a tiny bit of success, opened up my own personal trading account in March of 1995, and, started trading actively since then. Around 99, the firm asked me to run some money because they could see I had made money in my own account. And so I did that as well. And then in 07, the firm I was at, it was one of the first firms to go out of business in the, kind of pre-crisis. We were like a canary in the coal mine. Right. So I thought, I'm done with being a stockbroker. I wasn't much of a stockbroker, honestly, Adam. In the fact that I was more interested in the markets and trading my own account, right? Things like that. So I didn't really have a big book or anything. So me and a friend went out and decided maybe we'll build a capital company. Maybe we'll start a hedge fund. We didn't really know. So we decided to start a hedge fund in like 07. And by the time you get everything going and get up and running and do all that, it's not like you just start a hedge fund, there's a lot of work to it. Yeah. And there's just two of us, so we, that's, you have to hire outside compliance and outside lawyers and outside accounting. And so it's quite an endeavor. Time we got up and running, the financial crisis hit. So, it was really kind of hard to see the forest through the trees. And so after about a year, we decided, we didn't have as much AUM as we thought, right? Which is typical. Everyone says, oh, I'd be glad to give you money. And then when it's time to give you money, people get cold feet, of course. So they give you, our experience was they give you a lot less than they said. And so it was, 2009-ish, and I'm sitting there and decided, maybe I need a job. I'd been living off the markets for a long time, and everybody's dream is to trade the market full time. And most people start at a job as an engineer, a lawyer, I hear the stories. Oh, I want to do what you do, Scott. I want to trade the market full time. Well, I
Yeah.
went the other way around. I started trading the market right from the get go, and made my living, kind of a eat what you kill
Yep.
mentality for a long time and it's tough. There's years where it's incredibly lucrative, and then there's years where, if you don't make any money, you start digging into your savings, you can't, what if you lose too,
Yeah.
so now you're not only draining your account for expenses, but also, you lose some. So it's a tough road. It's not as glamorous as people might think. And so I had gotten to the point where it's like, I kind of have like a stop loss on my liquid net worth.
Yep.
I'd spent money building the capital company, spent money building the hedge fund, and decided, I think I'm going to go get a job.
Yeah.
Where do I want to work? Right. I'm at that point, I'm like, 30, 40 years old, something like this. And, it's like, Scott, you're sort of unhirable, to
Right.
be honest with yourself.
Right.
I have all the credentials and MBA and things like that, but I didn't have any real work experience, Adam.
Right.
My experience was markets. So, but there's one place in this world where that's super valuable, Adam, and I was lucky. And they're in my backyard, so to
That's
speak. I'm
awesome.
in Orange County. They're in Los Angeles. They could easily have been in New York, but Bill loved Los Angeles, and that's William O'Neill and Company Investors Business Daily.
Right.
So I started knocking on the proverbial door, emailing, calling in 2010, looking for a job in institutional sales. There was no job there, but they did say, we're launching a new product, MarketSmith. Are you interested in that? And I was of the opinion, just get your foot in the door. I'll take
Right.
whatever you have.
Right.
Everybody knows David Ryan's story.
Right.
And I thought David Ryan's story was one of the coolest stories ever when I would go watch David and Bill speak, how he got his foot in the door, started from scratch and worked his way up to portfolio manager. It's just so cool. So that's what I did in 2010. And I've been with the company ever since. Now, Dow Jones bought Investors Business Daily about a year ago. So we are no longer, part of the William O'Neill and Company, but Investors Business Daily, sits as a standalone company under the Dow Jones umbrella versus before it was kind of under the William O'Neill umbrella.
No, I love it. That's an awesome story, Scott. Let me just jump in for a second, if you don't mind.
Yeah, please do, because otherwise I'll keep going. I told you I would. I warned you.
No, this is awesome. So you mentioned a few things. One, David Ryan. I happen to have the Market Wizards book literally in my hand, where he was interviewed with Bill O'Neill, the first one from way back when. So if people aren't familiar with the story, you can go read it there, and it's a phenomenal story. That's one. Two, you mentioned back in the 90s, you started trading. It was buy whenever the market's open. So there was no structure to your trading. You weren't using technical analysis or fundamental analysis. You were just buying for the sake of buying and selling. There's no risk management, no portfolio, nothing. Then you came across CanSlim, IBD, William O'Neill, and all that fun stuff. For those in the audience that aren't familiar, can you give us an overview about Bill and CanSlim, the actual investment, or William O'Neill's investment system, or the overview of it, please?
Sure. Yeah, absolutely. So, the book that I have on my desk, and I definitely have Market Wizards and read it 100 times. The Market Wizards series is awesome. I love all of those books, but How to Make Money in Stocks. So the guy who was, kind of became my mentor told me, go and get this book. And so this is 1995. You just didn't go on Amazon.com in 1995.
Wasn't there, yeah.
I'm dating myself a little bit, but it is what it is, right? So I drove to 3 bookstores till I found the book.
Right.
And then I started going to the seminars that Bill would give for free. Then I started going to the paid seminars where you would get Bill and David Ryan. I believe it was $600 for a paid seminar all day with those two.
Nice.
Speaking of inflation, right?
Yeah.
And then the next time it was discounted, I believe you got 50% off. So you could go again anytime for about $300. So, what a great experience to get those two guys for 600 or 300, it was like stealing. Yeah. So, Bill's philosophy is laid out in this book, How to Make Money in Stocks, and it's an individual stock investing philosophy. It works super well for individual investors. Some guys have been able to lever this up for institutional. Jim Ropel comes to mind. He's the most obvious example. I think, a lot of people might know of Jim Ropel, but if not, YouTube
He's
Jim
available
Ropel.
on growthstockmentor.com.
Thank you. Of course.
Yeah.
Yeah. I mean, so Jim is an amazing inspiration because, he not only did he make it work in his own account, but he made it work with big money too, which is very impressive.
Yeah.
So the idea is, I think all stocks are bad unless they go up. Every individual stock has risk. And we are long-term investors. We're always looking for new ideas, new stocks, with the caveat that we know that based on history, stocks can go down, and they can go down a lot.
Right.
I think right here as we sit here, Shopify, Upstart, Netflix. Yeah. It's
Roblox,
funny. You thought of the same one, right?
Peloton.
These are all stocks that people never would have believed could go down 80, 90%. But if you're a student of history, you know that it's possible.
Right.
So we always have a sell philosophy. We're looking for signals, whether we're down on our initial capital, we use a stop loss, or if we get way ahead of something, we like to use charts to try to determine if the supply demand imbalance is out of whack. Does the stock look like it's going lower, and lock in our profits. So, and it's not all technical. In fact, honestly, I think it's a misconception. CanSlim is really more fundamental than technical, like a lot more. I would say 70-30. We want to buy the best companies. We want to buy companies with big earnings and sales and new products and new services and big margins and leaders in their industry. So that's step one. And then you identify those companies. And then step two is, okay, how do I buy this stock and manage my risk appropriately? And that's kind of where the technicals come in.
Gotcha. No, I love that. So I have a similar story of how I kind of intersected with O'Neill. I started in the 90s as well, and I was same thing, lost. I had no idea what I was doing. And then I started reading fundamental analysis and then technical analysis, but I realized they were like two feuding sports teams or religion. They just didn't, the fundamental analysts don't like the technicians and vice versa. And I realized I'm like, well, there's something missing here. Then I came across O'Neill's book, the same one, not the latest edition, but the one that was available back then.
Yeah.
And the same thing. I went to the bookstore and all that kind of fun stuff. And he combined both of them. And for me, it was like, wow, there's good here and there's good here, fundamentals and technicals. And then that's when the light bulb went off. So I did all of the O'Neill stuff as well, took the level 1, 2, 3, and 4, and I fell in love with it was like a no-brainer for me. I love that. So, okay, we spoke about the journey up until this point. When I jumped in, was there anything else that you wanted to mention, or was that a good overview of your journey?
Well, that's kind of how that was like phase one of my investing journey. Phase two is my experience at IBD, which is still going on, but also my experience at William O'Neill, working with, near and with Scott O'Neill and Steve Birch and Charles Harris and Mike Webster. And I could go on and on. I don't want to leave anyone out, of course, but it's such a great place to work if you're interested in markets. It's just so much fun to be immersed in it and encouraged, to invest your own money is encouraged there. We do fall under a compliance umbrella. We're not licensed or anything, but it's really an amazing place to work if you're into markets. So I was really lucky in that regard.
That's awesome. Yeah. So I love that. Let's talk about that experience, if you don't mind, and help some of the lessons of, like, you went into it and you came out of it. What were some of the timeless lessons you've learned along the way that you'd like to share with the audience?
Yeah, I think a couple of things that I really learned that were specific at William O'Neill and Company was when I was there, Scott O'Neill was the manager of MarketSmith. He's now, way up the food chain of there, of course. He's always been way up the food chain, but he's, I don't know what his title is, but he's probably president or something. But he was also a portfolio manager, and of course, Scott O'Neill is Bill's dad. I'm sorry, Bill's son.
Yeah.
So he would often, tell us great stories, and experiences with his dad. The eBay story is great, but it was really kind of cool to be part of, their process. Scott was a portfolio manager. I remember in 2010, Chipotle breaking out of a base and him coming out of the office and saying all of the portfolio managers are buying Chipotle.
Mm-hmm.
And it was really neat because none of the portfolio managers sat together. Some of them were at home. Scott was in his office, and Charles and Mike and Bill, but they all had that kind of same process and identified this stock as a leader, and they were all acting on it when the market was in a downtrend, the market was in a correction, but yet it looked like there's a chance that the market was changing. There was a follow through day that day.
Mm-hmm.
And it's just very important for me to see kind of that the asymmetry of how they trade, right? It didn't have to work, but if it worked, the upside was so much greater than their downside. And Chipotle happened to work really well. I know Bill did super well in that run. Mm-hmm. So that was an important experience for me, and just seeing how these guys act and how they identify leadership, and how they kind of the old George Soros axiom, shoot first, investigate later, right?
Right.
A lot of people, well, how do you know it's going to be a follow through day? Well, you don't know. You don't know. And how do you know it's going to work? Well, you don't know. Mm-hmm. But it was
That's okay.
Chipotle's breaking out of a base. It's got earnings and sales. And me and Arusha were going to Chipotle almost every day. And we would get there literally 15 minutes before it opens, because we only had a half hour of lunch.
Yeah.
And we didn't want to, if there was a line, which there would be, we were stuck.
Yeah.
You get all these factors, and you have the chance to make big money, versus if we're wrong, we use the stop loss and move on. So that's a story that really sticks out to me when they did that. And the other thing that Scott said that kind of hit home for me was, he said, my dad is very rarely completely out of the market. Mm-hmm. And this was a shock to me, because when I read the book, my kind of experience was you were either all in or all out,
right?
And when you're making your living from the market, you have this mentality, right? I'm sitting here, I need to, make some money. And I was, for a long time, I was like that. I was either all in, or if the market was bad, I was all out. Yeah. And that was a real light bulb moment for me, because Bill I never saw Bill do a trade, but from my experience listening to Charles and Mike, who shared an office with him, and Scott, of course, for years and years, he was always ebbing and flowing with the market, always probing, looking for things to see what was working. And if it wasn't working, he'd get out. If it was working, he'd give it more money, things like that. So that was another really good experience for me, because it taught me that, it's not an all or none game. I can be 30%, I can be 130.
Right.
If I get nervous and I'm 130, I don't have to go to 0. I can go to 70.
Right.
And in the last 10 years, it's really slowed me down. And the best part about it is you don't have that angst of making an all or none decisions.
Right.
So all or none decisions are really difficult psychologically, right? You own XYZ, you think it's a sell, you've got 1,000 shares.
You blow out.
Yeah. You have to make like a perfect decision, because if you sell it, you want it to, of course, go lower. Right. If you keep it, you want it to go higher. But so why not sell 200 shares and see what happens? Right. If you're wrong, if that 200 is a bad sell, great. You still have 800 shares. You could. Yeah, absolutely. I do that a lot. Yeah. And if it's a good sell, you start to get in motion. If I sell something at 100 and now it's 98, I like to do more of what's working. Yeah. That was a good sell. Maybe I sell another 300. Right. Now it's 94. Yeah. That was a good sell. Maybe I sell the rest of it, or another 300, things like that. Right. So those are the two kind of lessons that really stick out to me from that MarketSmith / William O'Neill experience.
No, I love that. So on a side note, well, the psychology you mentioned, so I want to harp on that for a second. I just published a book. It's called Psychological Analysis. It was #1 on Amazon for about 6-7 weeks after it was published. And my whole fascination or contribution to the investing world, if you will, is to be able to learn how to make rational, not emotional decisions with your money, and then deal with a lot of the psychological elements that as a trader that someone who hasn't traded won't really fully understand until they actually do it. It's almost like, the color of blue. You know what blue looks like, but can you explain it? Can't do
No,
it, right?
no,
What does
I don't
chocolate
know.
taste like? You
Yeah.
can't do it. But when you see blue or you taste chocolate, I can't give you vanilla and be like, that's chocolate. You have to taste it, you have to experience it. So with trading, I feel like it's the same way, Scott. I was wondering the psychological component of making up a good trader. I'm sure you've seen over your career, both with O'Neill, before O'Neill, after O'Neill, now with Dow Jones, with dealing with individuals. You're the product manager at IBD, so you've got a large audience here. What are some traits or behavioral characteristics that you see that successful traders employ or enjoy or
Yeah,
carry?
I think, discipline is number one, probably. They still tell amazing stories of how disciplined Bill was. And some of the traders that I know, some of my friends that trade, they're super, super disciplined in their process. And also in their life. I know, there's one particular portfolio manager at William O'Neill and Company that everything in his life is very disciplined and rigid in what it comes to exercise, how he eats,
Yeah.
things like that. And I think it all filters down, to your trading, so discipline is important, but it's kind of an overrated term. Like everybody knows, oh, I should be disciplined. But the problem with discipline is if you don't believe in the process, when you need your discipline the most,
You give up, yeah.
you're gonna get rid of it. So yeah, everybody knows what we should be eating, and everybody knows that how that we should be exercising and moving and not smoking. These are not secrets to the
Yeah.
world, but the process of actually implementing it is a lot tougher, right? So, discipline is the biggest key, and I think that's one thing I love about Can Slim is it's got the rules and they give you that discipline, to follow these rules. You just I honestly have to believe in it. So when I first started, I was super disciplined where, oh, Bill says it's down 6%, I need to sell, I would just sell. And, and I just follow the rules. But then I got smart at them. I started to develop some experience, started to notice times that I took a loss, that the stock didn't keep going down, where that's, why should it go down just because you sell it? And so you start to get outside your discipline just a little bit here, just a little bit there. So, you have to notice that and kind of get back on that bike and get back to, following your discipline, your process. I think that's the biggest thing.
I love that. So again, in the book here, I've got cartoons, and I think it's the first investment book that has cartoons. So the whole idea is we all have a good side and a bad side, Scott. And the small guy with the horns, he's what I call the dumb money beast, and the other guy's your superhero. The dumb money beast is the one that's the emotional Tasmanian devil kind of character going out there causing you to make them, just lose a discipline and lose focus. And then the smart money superhero has got to come in and quell that and say, no, stay focused, stay disciplined. So I love what you're saying here.
Yeah.
So,
I think what I would say is that, a lot of people might say you need to be robotic in your trading. And I've heard that for a long time, but I just don't think that's possible, at least for me. I've just found we're all human. But if you can learn to recognize your emotions, you can use that to your advantage. So even for me, 25 years later, I know I get really bearish at the lows of the market. I'm always, it's always the next great financial crisis at the lows for me. So I know that. So recently in the market, it's really bearish, what turned out to be the lows, at least so far. But I
Mhm.
was able to recognize that and say, maybe this is not, the end of the world, so to speak. I
Right.
might not go 100% long at that point, but
Yeah.
if I'm short the market, I
Mhm.
start getting out because I
Yeah.
know based on my emotions. So learn to read your emotions. They will guide you, but you have to almost always, at least for me, read them from a contrarian point of view.
100%. I couldn't agree more. So, Scott, let me talk about shorting for a second because a lot of canceling is most people understand it on the long side. Can you talk a little about the short side? Did Bill short as well, or other portfolio managers, or is it just something that you do, or and how does that come into the canceling picture, so to speak?
Yeah, it's a great question. I don't think Bill shorted that often. He would go short, but I think even he mentions, now the book was written a long time ago. I think in the book he said I've made money in two of the last, dozen bear markets.
Hmm.
So bear markets are really hard. It's hard to make money in short, going short.
Hmm.
I do go short because, like I said, for the longest time I was making my living from the market. So
Right.
if we were in a bear market, like I traded from 2000 to 2003,
Yeah,
you
me too.
know, there's if you're not going to go short, then you're just going to sit out and
Yeah.
just wait it out. If you're trying to make your living from the market, then I think knowing how to short is, something you should have in your toolbox.
Hmm.
If you're a doctor or a lawyer or a school teacher, I don't think you want to. I think just forget about it. Just learn the big money is made going long.
Yeah.
Wait it out. Just sit on the sidelines and mostly cash. Every dollar not lost is a dollar earned.
Yeah.
And from your standpoint, from a psychological standpoint, if the market goes down 50% and you only lost, let's say, 10% off the highs, you have a lot more mental capital than the other guy down the
100%.
street who went down 50%. If he's
Yeah.
lucky, he might have gone down even more
Yeah.
because individual stocks go down a lot more than the overall market.
Yeah.
So I have mixed feelings about the short side. Uh, it's tempting. You can make good money, and the money is much faster than
Hmm.
being long, which is why it's probably tempting. But honestly, some of my worst days in my market history have been from being short on a day where, like
The market
today,
rips higher. Yeah.
if you're
Yeah.
short coming in today and
Yeah.
the NASDAQ opens up 2.5%, and by the
Mhm.
end of the day it's up 5% or something like
Yeah.
that, you just get run over.
Agreed.
It's disheartening.
Yeah, it is. So I couldn't agree with you more. I always like to say with the shorting, it's just the longs in reverse, like the inverse of it. But yeah, it's not for the faint of heart, no question. So let's talk about we talk about timeless lessons, timeless mistakes. What are some timeless mistakes you see people make, and how do you avoid them?
uh I don't know if you can ever avoid them. I could tell you and all your listeners a million times that you need to, cut your losses short, but till
Mhm.
you experience it more than once, probably if you're stubborn like myself,
Mhm.
um, you you're just not gonna, believe it. It's kind of why the
Right.
market cycles the way it does, from kind of craziness back to reality, from craziness. I've lived through this has been a pretty bad bear market, I think,
Yeah.
regardless what the indexes have done.
Yeah.
But this is like my third or fourth once in a lifetime bear market.
Right.
Um, 2000, the 2008 crisis, the COVID market was really bad. The good news was it was so short, most people
Yeah.
didn't have time to get their 401k balances and panic. And then this one that we've been in. So I think experience is the best teacher. You can read about it in the Market Wizards books and all these books. I love books, Adam. I
Me
have,
too.
gosh, probably 250 books on the market.
Yeah,
And
mine's in front of me, not behind me, but I got the same thing as you do. I love it. Yeah.
I just
Yeah.
it's where can I get one guy's experience, and I can read it in 2-3 days or something, a lifetime of experience. So
Yeah. It's heaven.
these will help. They will accelerate your learning curve, but I think you have to experience it once in a while. Like Jim Rogers says, he was lucky he went broke when he was young.
Right.
So, you really,
So did I, by the way. Yeah, I couldn't agree with you more. Yeah, that's
you really
awesome.
want to, you start small, you learn. Maybe, a lot of people you've heard, a lot of famous traders have blown up more than one account.
Mhm.
So you just got to get in there and get that experience and start learning from it, hopefully.
I love it. So, next question for you, Scott. What are some time, I guess, how do you manage risk? And then what are some timeless lessons you've long learned with respect to risk management and mistakes? And like, how do you avoid it? You said cut your losses. So you're buying something and then it goes down 7 or 8%, you sell it. I'm assuming that's the guideline, or do you do something
Usually
different?
sooner, but yes, that's right
Okay.
from the book. 7 to
Yeah.
8% is your max loss.
Hmm.
That's kind of the alarm bell. That's the insurance on your portfolio. You don't want to let it get worse than that if you can help it. If it
Yeah.
gaps down 10%, then you got to take 10. But
Right.
yeah, and that's on your cost of capital. If you buy NVIDIA, you buy Apple, you buy Google, you're up 80, 90, 200% or whatever. That's
Different
different. You want to
story.
manage that trade differently. But
Hmm.
every time you enter the market, you want to use some type of stop on your cost of capital. That's rule one.
So you don't use 7 or 8, you said earlier. Do you exit 3, 5, 7 or 4, 6, or how do you
I,
exit?
I usually exit a little sooner because I'm more active trader. So
Okay. Got it.
I might try ABC 3 or 4 times before I get it right, if it's going to turn out to be a good trade.
Gotcha.
So I might buy it at 100 and get out at 98, buy it at a 99 and a half on the way back up, get out at 98 again,
Yeah.
buy it at 99 and a half again on the way up. That one works.
Gotcha.
I have no problem trying two. The third try is a little more difficult. I usually don't go back to it the same kind of setup 4 times. At that point, they've taken the starch out of me and I'll move on to another stock.
Yeah.
But yeah, I usually like to, if I can, keep the losses smaller. They're just easier to absorb psychologically. Van Tharp has a great quote about, it starts out as a small loss, and then as it grows and grows and grows, eventually the loss becomes so large you can't take it anymore, and you take the large loss.
Yeah.
At some point, I've seen it as a stockbroker. I've seen it in this business.
1 second
At,
rule. Yeah. Yep.
yeah, at some point, the pain will get to everybody out there. So you might as well take the small loss while you can. Knowing that they're not always going to continue to go down, which is what most people want.
Yeah.
They want to be right,
Of
and
course.
that's
Oh, it
the
is.
hard part about the stock market is you can be. It's like baseball.
Yeah.
I love the baseball analogy. Otani with the Angels right here in my backyard. What did he bat last year? I'm going to guess 260 is what he batted. He was the MVP.
Yeah.
And he was, and let's throw in the walks. Let's say his on base percentage is 340. That means
Mhm.
he's right 35% of the time. So
Yeah.
he's wrong 65% of the time. And
Hmm.
he was the best player in baseball.
100%.
So
Yeah.
you can be the best investor out there and be wrong 65, 70% of the time, because the magnitude of your winners, if you're playing that type of strategy, will overwhelm your small losses.
I love that. And then, from your opinion, Scott, well, before I dive into that, so you trade full time, and you have for 25 years. How do you incorporate news with decisions? Do you exclude the news? Do you look at the reaction to the news? And then earnings? I know MarketSmith is one of the products at IBD, and it's a phenomenal product. How do you, can you talk a little about earnings, news, and then the actual price, and then how that comes into your actual trading?
Sure, it's a good question. So there are two things, earnings and news, and sometimes it's the earnings news, right?
Right.
So, but like today is news, right? The CPI number.
Yeah.
So it's always the reaction to the news. I don't even honestly know what the CPI print was, Adam.
Right.
And I don't even really want to know because it might influence me, either way.
Yeah.
I'll let the big money vote. The really big money will vote. And the way they vote is with their money, right? And so the
Yes.
market's, higher. So the reaction to the news is most important to me. And
Okay.
the same kind of thing with the earnings. XYZ reports great earnings, the stock can go down.
Yeah.
XYZ reports poor earnings, the stock can go up. I think UPST is a good example. I think they warned,
Hmm.
and the stock was down, initially. But now it's, basically unchanged from where they warned.
Yeah.
And, that's kind of hard for most people to understand, but the market kind of knew that, that warning was coming. It's being baked in. The
Forecast.
market's
Right.
constantly looking ahead, which is why, reacting to the news is not, it's not a great strategy. I don't see how you could make money consistently doing that because of the way the market works.
Gotcha. Yeah, no, this is very, very good, Scott. So I guess what's the best piece of advice if you can go back to yourself back in the 90s when you got started trading and you knew that the brokerage stuff and the smiling and dialing is not for you? What would that piece of advice be? Or what would you tell your 20-year-old self or 30-year-old self?
I think there's a few things that I would do differently if I
We'll
could.
take them all, by the way. It's not one piece of advice. We'll take 10 or 20, as much as you want.
Yeah. Um, if you're going to trade for a living, which is what I was doing, I think one thing that I wished I had done was take every year that I made money, take 10% of my profits
Hmm.
and buy a mutual fund, buy a
Hmm.
Fidelity Contra fund, buy a Lord Abbett Growth, buy a Vanguard S&P fund,
Hmm.
and set it off to the side and don't even look at it.
Right.
And then if you lose money the next year, you don't make that much, you don't do that. But then you have another great year, you take 10% of your money and put it off to the side. That's one thing I wish I had done. I could only imagine the amount of money I might have in a Fidelity Contra fund if I had done that for the last 25 years.
Yeah, it's just,
Now, I have to be honest, in the '08 crisis or something, as the money would have got larger, I don't know if I could have stayed the course with that discipline, although it would have worked like a charm, right? Because,
yeah.
in '08, I made a little bit of money being short. I could have moved some of that money into Contra while it's down. So you want to have some longer term type of investments. As a trader, there's no 401k, there's
Right.
nothing like that. So my favorite thing in the world besides the wheel, Adam, is the Roth IRA.
Nice.
I'm not licensed. I'm not a tax expert.
I hear you
I
loud and
can
clear.
only tell you from my personal experience.
Yeah.
And I discovered the Roth late. And,
Hmm.
I did not have, a Roth at 28 years old. I think I
Right.
started my Roth in my late 30s. The
Hmm.
power of compounding with no taxes,
Heaven. Yeah.
it's unbelievable. I just could never see the forest through the trees of putting $2,000 into an IRA or five
Hmm.
grand into a Roth. But that's the one thing that if I could go back, the mutual fund thing for sure, but get some money into tax-free accounts, get
Hmm.
some money into SEP, Roth, 401k, and the reason I like Roths and SEPs or regular IRAs, or if my kids have Coverdale accounts, which
Hmm.
is tax-free for education,
Hmm.
is you can do individual stocks in
Right.
those.
Right.
Not every some 401ks allow you to do individual stocks, I believe, like
Mhm.
Fidelity does,
Yeah.
but some don't, right? So
Hmm.
um, that would be rule number one: is Roth IRA. Get some money into a Roth IRA. Just get it started, whatever it takes. Because once you have it open, it's a lot easier to start adding and getting money into it.
Yeah, no, I love it, Scott. I mean, on a personal note here, which I haven't shared before, my best trade ever or return ever is in my SEP IRA. I'm self-employed, so it's like the Roth, but for self-employed people.
Sure.
And my account went up tenfold, or over 1,000% in about 6-7 years. It was a short amount of time, but it was just a phenomenal run. And that not having taxes component and planning for the future and long term and all that stuff it's one of the best pieces of advice I think anyone's ever shared on the show. So thank you for that very much. It's super
You
powerful.
got it. That's awesome. That's really
Yeah.
cool. And I can tell you, I know a few people that have done this. So and if I can do it, anyone can do it, because
Agreed.
the
Yeah.
amount of mistakes that I make in the stock market is tenfold everyone else. So if even I can do it, there is not a single person who watches this that can't do it, that cannot grow a tax-free account to significant, bordering on life-changing money. It's, knowing that you have that out there. And the thing about the Roth, I assume everybody knows, is that, you put $1 in a Roth and you turn it into 100 grand.
Yeah.
That's tax-free.
100%.
That's tax-free. I just hope they don't change the rules on Roths, because I think it's just an amazing product.
It really
Anyways, that's my piece of advice.
Yeah,
and
no, I agree
again, the caveat, I'm not licensed, I'm not a tax advisor. It's just from personal experience.
Yeah, likewise on my end too. So yeah, I love that 100%. So thank you, Scott, very much. It's been an absolute delight, an absolute pleasure having you on the show. If people want to get in touch or go on IBD to get some of these products or MarketSmith, what's the best way for people to do that?
So investors.com website, MarketSmith, .investors.com is, our premium research tool if you're interested in that. So those are in, and I'm on Twitter, and although I don't tweet that much just from a compliance standpoint, but MarketSmith has a Twitter account and I have a Twitter account as well.
Excellent. What is your Twitter account so people can follow?
It's at Zen in the Markets. ZEN in the Markets. Yeah.
Beautiful. Well, this has been an absolute pleasure. Hopefully we'll have you back soon again. Thank you so much, Scott. This
you
is
got
awesome.
it, Adam. Thank you. Thank you for the invite, and have a great day.
All right. Talk to you soon.